Right, let's get on to Regis. They've released a poor pre-quarterly. They're down 11% today. Now, if you've read the first line, it looked all right. It's 103,000 ounces at $53 million increase in cash and bullion, but this includes a $67 million tax refund. So you could say operationally they've gone backwards $14 million. As I said, trading down 11%. They've revised their ounce and cost guidance. JD, unpack it, mate.
Yeah, so I think what you highlighted with the stock price down over 10% really summarises what the market thinks of the announcement, despite that headline, $53 million cash and bullion. So always good to compare these to what the expectations were. Consensus expectations for the March quarter were 120,000 ounces produced across their various assets, and they produced 103, so 15 to 20% miss on that. And the company hasn't provided any all-in sustaining cost. It was just a one-page sort of pre-quarterly report. But from the revised guidance figures, you can see that the costs look like they are also amiss and going to be significantly higher. So if we compare what the midpoint of all-in sustaining cost was 3/4 of a year ago when they were looking forward to 2023, the midpoint was 1,575 Aussie dollars all-in sustaining cost, and it's now looking at about 1,820. So quite a significant increase. And you do need to bear in mind that there's been cost pressures across the entire industry, and there's also been revenue increases with the increasing gold price. So we're expecting across the board costs have gone up, and margins should also be going up commensurate with that increased gold price. Of course, there's a hedge book at Regis that hasn't served them so well over the past few years. So looking forward, on Canaccord's numbers, 23% of the next 1.5 years, so roughly, I think 170,000 ounces are hedged at roughly 1,500 Aussie dollars. That's 1,500 Aussie versus a current gold price of 2,900. So I think you did a bit of back of the envelope maths on that one.
Yeah,
maybe.
well, if this hedge, they've got 100 from this, including this quarter, they've got 170,000 ounces hedged at 1,571. So today the gold price is 2,992. Look, if you work that out at, let's say, hypothetically, the gold price averages $2,900 an ounce all the way through that period. So that 170,000 ounces, that equates to $226 million in lost revenue due to the hedging.
Yeah, it's not great. In particular, when you read this report today, issues at Gardenwell, issues at Eucton, issues at Rosemont, issues at Tropicana, not all are necessarily the company's fault. They had poor weather, like we've seen with a number of other operations across the country, really, over the past quarter. But yeah, a lot of the assets not really humming along at the moment, which is a bit disappointing for the company.
Trav, is that hedging, is that going to stay, is that locked in? Or is there opportunities that will be drawn out a bit longer?
You can look at a company's hedge book and it will say they're delivering X amount of ounces at Y price on a certain date. And the reality is that quite often these companies, they will refinance their hedge book and spread out their obligation over a longer period of time so that they can benefit from an unhedged price for longer. So in some ways, it's just sort of kicking the can down the road, though. But you wouldn't. It's not uncommon for gold companies to just refinance their hedge book on a pretty regular basis.
Yeah, because you look at their last quarter, so they've got 25,000 ounces for each of these quarters coming up, and 30,000 ounces for every quarter in FY24. So
yeah, it's about a fifth of their production over the given period, but
yeah, about nearly half the gold price. So look, they've got the McPhillamys buck coming online, JD. That's they've got approvals for that the other week. That's going to be probably a big kicker for Regis going forward.
That's something that's really exciting. I think a lot of investors will be quite stoked with that. So the approvals that they received in a few weeks ago now were about 5 or so years in the making. So I think
it sounds like a Canadian bloody mine.
Yeah, exactly. And this is in New South Wales for those unaware. So that asset is going to be they're going to come to a final investment decision in the next 9 months for that. So some analysts have sort of penciled in construction starting beginning of 24, roughly 2 years of production. That would mean first gold in the first quarter of calendar year 2026. And just to give you a few numbers on this asset, it's pretty huge. They're expecting about just over 200,000 ounces per annum. It'll involve 540 million, according to some analysts, capital expenditure. So that'd be over 25 and 26. And 9-year mine life, I think it was for an initial 9-year mine life. So it's quite an exciting operation, and that'll sort of bring out the expected ounces over those periods from 2026 beyond, where we could potentially see Duketon come off a little bit. We'll have to see what the company comes out with there.
And big operation. So 7 million tonne per annum for McPhillamys. So like, look, Karlawinda, that's 4.5 million tonne. So it shows.
Yeah, I think the strip ratio was 6 to 1 at McPhillamys there.
And looking at Canaccord's model, they've got Duketon. So they've got McPhillamys coming online 2026, but Duketon scheduled to finish in 2026 as well. So there's about 100 ounce predicted drop in their 100,000 ounces for their annual output. So, but based on the resources, there's 4 million ounce resource at Duketon South and another nearly 1 million at Duketon North. So there's probably potential. An upside risk is there's potential for resource mine life extension at Duketon. So that could possibly not see as much of a reduction in gold pending a mine life extension.
You do see ounces drop off a bit over that 26 and beyond period, but always key to remember what we have spoken about before is margin over ounces. So this new ore body coming online, you'd expect the costs to be significantly lower. And, depending on what those costs are, it doesn't matter whether you're doing 300 or 400,000 ounces. It really matters the margin you're making.
And it looks like their Canaccord model have got a lot of free cash flow getting generated from 26 once that capital's been put into McPhillamys. So, look, there is potential there.
Yep, that's right.
They're obviously going through a bit of a rough period at the moment. Now, Trav, how do you think they're going to fund McPhillamys? Above $500 million CapEx, what's it looking like, debt or equity?
I think the market probably, rightfully so, was a bit upset at how dilutive their acquisition of the 30% of Tropicana was. $650 million of that was raised via equity. So if you're financing McPhillamys, my eyes are going to be pretty interested to see if how much equity, if any, will they'll sideline for the development of that. I mean, 500 million is sort of the capex number we've got at the moment, and it'll be a while before they'll meet all of that. But
we've seen some numbers floating around that the company would have 400 million off the top of my head in cash come, I believe it was end of 24. So that implies that money will need to be raised one way or another.
Debt can pretty easily do the rest of that. It's just that if their other operations are cash neutral, then come time when you actually need the money, then that'll be the interesting scenario to watch.
Yeah, Trav, you mentioned to me before for the Tropicana acquisition how it was a massive raise, very dilutive. How they acquired that? Do you think they won't go down the same road? Be looking at more debt to finance this?
I think so. I think the general consensus in the market was that was a big equity raise, especially in gold. You don't see an equity raise like that too often, and especially I think the other piece that the market didn't quite like was they had a general view that the price tag paid was too high, and you saw their share price sort of come off in a pretty meaningful way after that acquisition, and that's not a coincidence.
Yeah, they got a bit of ground to make up. So since the departure of Mark Clark, I think it was 2019, because they were up.
I think a year before.
Yeah, 2018. So I think they were up near $6, and they've pretty much.
Well, keep in mind, why did they buy Tropicana, right? And it was because the company had a growth problem because McPhillamys approvals were taking so long, and that growth problem they solved via M&A. There, they paid too much probably, but now that growth problem seems like it's solved because they can actually build McPhillamys.